Good afternoon, everybody. First of all, very pleased to be presenting the highlights of a strong first half of trading for our financial 24. And that's myself, Louis Hall, CEO, and Andrew Dickson, CFO. So first of all, for those of you who aren't familiar with the story, and as a quick reminder to others, we provide mission critical core enterprise software to all kinds of telecoms businesses worldwide. This is a software that enables telecoms businesses to monetize their network infrastructure assets through the software that they use to onboard their customers, to create the products they sell to those customers, to manage those customers' usage of those network assets, to bill for that usage, and to manage the receivables arising. And we provide this software on a software as a service basis, meaning that all customers share the same standard set of products. And this is indeed for us a very clear differentiator in a market that has traditionally been dominated by much more tailored solutions. And typically, this software is provided over 5-year term subscription agreements. As I said earlier, we have a global customer base, and we have every kind of telecoms provider, operator, business, whatever, within that customer base. So we have everything from fully integrated network operators, service providers, through pure wholesalers, network wholesalers, usage wholesalers, messaging exchange businesses, through to standalone mobile operators, mobile virtual network operators, mobile virtual network enablers who enable MVNOs, and so on. So very, very broad range, which gives us lots of different places in this market that we can be active and find opportunity. Just a little bit about the size of the market. So Analysis Mason are one of the analysts that cover this sector. This sector is referred to in industry as BSS, OSS, or which used to stand for back office support systems and operation support systems. So in this market, which is essentially the core enterprise software market for telco, we have an estimate here of relatively slow growth, 3.5% CAGR, but a market which is, as of today, around $60 billion annually. So a significantly large market. And even if we discount some areas where perhaps we can't fully address all of this market, so for example, we don't compete in China, even if this number was only 10 billion, that would still leave us with a lot less than 1% market share. So we have a very broad space to grow into organically, and that gives us a lot of confidence about the future. A little bit about competition. So our competition breaks down into these 4 main groups. So first of all, we have the large independent software vendors. These have traditionally provided much more tailored service-heavy solutions. And to an extent, the same is true of the second group, the network equipment vendors. In this group, the main players are Ericsson, Nokia in the western part of the world, and Huawei and ZTE out of China. Nokia don't have all of the modules in the enterprise software suite, so include some of our modules in their offerings. So Nokia are a partner rather than a competitor. Ericsson, we do compete with their suite, and the Chinese vendors also have full service suites. The Chinese vendors obviously are present in Asia Pacific market, but not really present much at all in our main European and North American markets. So that obviously helps us enormously. The next group of competitors is the smaller ISVs, smaller independent software vendors. And these tend to focus on the emerging markets, so where the competition is mainly about price and at a lower value point. So we don't really compete in that market these days, so we don't often see that group very much. And then finally, there's a newer group of players who are SaaS vendors that provide individual components within the overall product map. So, for example, you might have one vendor providing a CRM solution on a SaaS basis, another vendor providing just charging, another vendor providing billing, another vendor providing service fulfillment, somebody else doing workflow. And of course, in that scenario, whilst there's the advantage of having SaaS products, software as a service products, where we're talking about, again, about off-the-shelf products being easy to provide, the fact that they all have to be made to work together nearly always involving one of the larger integrators, makes this a much more expensive solution and makes it take much longer to get it actually delivered to the customer, to the telco customer. So all in all, our main differentiators are the faster time to market, lower total cost of ownership of a product-based software as a service solution compared to the much more expensive, much less flexible, heavily tailored, service-heavy solutions that are provided by most of the competition. And just finally on the market, we do have very high barriers to entry in this space. Clearly, there's a lot of R&D required to create a new product suite. So for a new vendor to come on the market, that would be a significant amount of work. I think 20 plus years is significantly overcooked. It's probably more like 100 years. It's an awful lot of software, and it's an awful lot of testing, and it's an awful lot of work to get that right. These other factors are also important. They need a lot of domain expertise to be able to do digital transformation in telco, and the market is always evolving. There's always another G, 3G, 4G, 5G, 6G in the pipeline. It's not a stationary target. But I think by far the most important barrier to entry is the credibility point. So given this software controls how telcos connect their customers, their networks, it controls how they get onboarded, but even more critically, whether those customers can make calls, whether they can get internet connection. If the software stops working, then literally customers are thrown off the internet, mobile calls fail. So to have credibility to be able to be chosen to do this work in this space, you've got to have a track record, a long track record of continuously delivering successful solutions to telcos of all different types. And you have to be able to enable your prospects to go and see those customers. So you've got to have very, very strong references and very happy customers. So significant barrier to entry. So we're very pleased, as I said earlier, to see a strong set of results for the first 6 months of 24 with record highs against all the major KPIs. And I'll leave it to Andrew to go into detail on that in a moment. But I think we're also very heartened by the fact that we had a significant increase in new orders, with our total new orders increasing by 32% to 20.2 million. And that included the 12.4 million euro new contract we signed with a new European Tier 1 logo back in November. And if you look at the chart on the right-hand side here, you can see a clear trend of ever increasing new orders, albeit we had a spike back in 2021 when the first half of 21, a lot of the new orders all fell into the same half period. So there was a bit of a timing issue there, but we're seeing very strong momentum across new orders building. The other very positive thing for us, I think, at the moment is that our new customer pipeline increased by 20% over the first 6 months of the year to 254 million. And I think that's really positive in a market where there has been some negativity, or at least some talk of negativity. I think it's worth saying that in a market where perhaps CapEx spending by telco on network infrastructure investment, so on rolling out 5G and on rolling out more fiber, may be under some pressure. The software we're providing is part of the how do you become more efficient, how do you become more effective in the market with better, more flexible products and more flexible responses to changes in the market. So the software that we provide is in many ways part of how do we reduce OPEX and get more value from CapEx. We're also very pleased to announce last week that on the same day's results that we had converted $11.1 million of that sales pipeline with the contract win we announced last Monday with a new and growing customer in Southern Africa. And I think, with the additional resource we've added into the North America, Central Europe, Asia Pacific in financial 23 last year, which has also contributed to this pipeline, we are very confident about there being more signings of new customer logos in H2 and beyond. So all in all, we believe we're well positioned to achieve our targets, and that's given us the confidence to increase our dividend by 21% to 4p in the pound. So I'll now hand over to Andrew to go through the financial KPIs in some more detail.
Thank you very much, and good afternoon, everybody. So as Louis said, the first half was another strong period with revenue up 10% to £22.5 million, adjusted PBT up 14% to £10.5 million, and further cash generation with net cash up to £26.6 million. So going through each of the KPIs in a bit more detail, Starting with revenue at the top left-hand corner, you can see that going back to 2019, revenue has increased each period with a compound annual growth rate over the 5-year period of 26%. Looking at the adjusted PBT graph, you can see that the gradient of that graph is a lot steeper than the increase in revenue. And that is because over time we have been benefiting from operating leverage. So the incremental revenue has been dropping from revenue all the way through to profit. Looking at net cash, as I said before, cash up to £26.6 million. And there's a slide a little bit later on talking about that cash performance in a bit more detail. Lou's already talked through the new orders, but you can see new orders up 32% to £20.2 million. And that feeds into the back order number you can see in the graph in the very middle of £47.1 million, which gives us a good amount of visibility into revenue that will be recognised in future periods. So that £47.1 million is made up of two components. First of all, £37.6 million of orders that have been contracted, but not yet recognised as revenue. And we're flagging we expect around 40% of that balance to be recognised as revenue over the next 12 months. In addition to that, there's £9.5 million of annualised support and maintenance revenue. But of course, the £47.1 million doesn't include the benefit from the $11.1 million deal that we announced last week. In terms of recurring revenue, the recurring revenue run rate increased up to £15 million. There are two components to this. First of all, the managed service run rate, which you can see from the next graph. And on top of that, you've got the impact from support and maintenance, which I've already talked about. What we don't include in our recurring revenue run rate at the moment is the impact from term license renewals. So as a reminder, our typical contract is over 5 years. Under IFRS 15, we recognise the license revenue up front when the software is available for use. And then at the end of the 5-year term period, we would, because we've got a very sticky customer base, we fully expect our customers to renew. And then we can recognise that license revenue up front again. We think we're showing a very prudent metric here because the £15 million doesn't include the impact of the term license renewals. But that's something we're looking to address in the KPIs that we're planning on showing during the year-end presentation. In terms of adjusted EPS, this really flows from the increase in adjusted PBT. The increase in EPS for the period was slightly lower than the increase in pre-tax profit, and that is due to the increase in the UK corporation tax rate, up from 19% to 25%, as we had anticipated. And finally, on this slide, you can see our progressive dividend policy, with the interim dividend up 21% to 4 pence per share. So turning to the financial highlights slide, as I said before, Cerillion has a track record of delivering strong revenue growth, high margins, and good cash performance, and this continued in the first half of the year. Revenue of £22.5 million, the increase from the prior period, as you can see, was mainly due to an increase in software revenue, and this was driven by a higher level of license revenue that was recognised in the first half. In terms of margins, you can see the margins we delivered in the first half of 80.4% for gross margin and 48.9% for the adjusted EBITDA margin were very high. We are flagging that in the second half of the year, we're expecting a lower proportion of license revenue to be recognised, and therefore we would expect the margins that we report in the second half of the year to be slightly lower than in the first half. And finally, you can see again Cerillion's good track record of cash performance with net cash up to £26.6 million. That has enabled us to increase the dividend up to 4 pence per share. So this slide looks at cash generation in a bit more detail. I think the thing that stands out here is the other side from the high level of license that was recognised in the first half, and that is through the increase in working capital that we see here. So working capital up £3.9 million, and this is really driven by the higher level of accrued income that we see on the balance sheet. As a reminder, because we recognise the revenue up front when the license is available for use, but the customer typically pays on a straight line basis over the contract, what that means is as we recognise the license, we see accrued income being recognised on the balance sheet, which will then unwind in future periods as the cash is collected. In terms of capitalisation of development costs and purchase of PPE, Those numbers are broadly in line with the prior period, but you can see an increase in net interest and tax paid. That is really driven by higher tax payments due to the increase in profit and the increase in the tax rate I've already discussed. And finally, the graph at the bottom shows a reconciliation of opening net cash through to closing net cash. You can see that free cash flow generated of £4.7 million was higher than the dividends paid out, and also the amount we spent on lease payments. And that's the story of how we get to the closing net cash of £26.6 million. So in terms of the detailed consolidated income statement, really just 4 additional points to mention on here. First of all is that we continue to invest in R&D. So in the first half, we invested around 6,000 days into R&D, which was up around 17% on the prior period. We capitalised £600,000 of development costs, which was broadly in line with the amortization charge. So overall, there was no net accounting benefit from our accounting of these development costs. Secondly, you can see there was a decrease in the depreciation and amortization balance of around £500,000. This was really driven by non-repeat of £500,000 of amortization from the prior period. So this related to amortization of an acquired intangibles balance. This became fully amortized in the prior period and therefore was not repeated. Thirdly, in terms of operating expenses, you can see operating expenses on a reported basis fell by 2% to £8.1 million. If you strip out the non-repeat of the £500,000 amortization charge, operating expenses actually increased by 4%, but that is still lower than the increase in revenue of 10% that we reported. Finally, on this slide, you can see the increase in the UK corporation tax rate up from 19.7% to 22.8%, and that was mainly driven by the increase in the UK corporation tax rate. In terms of the consolidated balance sheet, I think the key point here is that the balance sheet remains incredibly strong. Net cash again up to £26.6 million. There's no debt on the balance sheet, and there was an increase in net assets of 34% versus the prior period. As we anticipated, there was an increase in accrued income versus the period, which is included within the other receivables balances. So accrued income at the end of March was up to £19 million, which is £3.9 million higher than it was at year end. And the increase, as I said before, was linked to the higher proportion of license revenue that we recognised in the first half. Finally, in terms of the consolidated cash flow statement, this is mainly here for reference, but it shows a detailed reconciliation of profit down to the closing net cash balance. But I think all the key points have really been discussed on the previous slide. Back to you, Lou.
Thanks, Lord Andrew. So just to close off with some operational points, as Andrew said, we spent just over 6,000 man days on R&D in the first half of 24. And the main focuses for us there have been around AI support for the creation of new products, new business processes in our software suite. And that has been attracting a lot of attention with both prospects and existing customers, and demonstrates the potential of AI to make quite large improvements to how telecoms businesses manage their key offerings. And also a lot of work going on improving our digital experience tools. So these are the tools that our customers, the telcos, use to communicate with their customers through online self-service, mobile apps, and so on. There's a lot of focus across, I think, many sectors on improving that experience as more and more B2C business is done online, direct with customers through digital channels. And in addition to that, equally important, I think, in terms of use of AI is our use of AI to improve software development. So to make that more accurate by using AI tools to generate source code, for example, and to generate the tests we use to test that software and to run the tests that we then generate automatically for that software. But I think improved accuracy we will get as we go forward from using AI in the development space, as well as the improvements in productivity, will be significant factors in our industry. So it's very important we stay on top of that. We've also, as I referred to earlier, added additional sales resource in North America and Asia and in Central Europe, and we're seeing the benefit of that come through into our pipeline. So very pleased with that progress. In terms of our international bases, our main bases remain UK, Bulgaria, and India, with sales presences in the US, in London, in Brussels, in Singapore, and Sydney. In the last 6 months, we've created a full subsidiary now in Bulgaria because we see that as a growing staff base for us, where we're focusing on people with delivery skills and with support skills, particularly important for our EU customers, a number of whom now require us to have support provided from within the EU. And we've recently agreed terms for a much larger office there to enable us to support that expansion. Similarly, in Singapore, we're in the process of creating a full subsidiary to support our sales presence there. And then finally, a couple of quite significant projects that got finished in the period. So in March, we completed the migration of all of the customers of the main telecoms provider in the Seychelles, CWS, onto our new platform, bringing that project to a very successful conclusion. And then in Suriname, we also completed the migration of the fixed wire base. We completed the migration of the mobile base last summer. So this was completion of that project in full. And again, TeleSur is the main telecoms provider in Suriname, traditional PTT. So in summary, as Andrew's explained in detail, we've seen very strong results against all the key KPIs. We're confident that the demand in the market is out there, that it remains strong, particularly for software as a service offerings such as ours, where we think we have a very important differentiator. We've come into the second half with a record new customer logo pipeline. And again, just last week announced that we converted another prospect into a contract win. As Andrew's reinforced there, we have a very strong balance sheet, and we believe we're very well positioned for current market expectations, both in 24 and beyond.
Can you provide an update on how the implementation for the Tier 1 European telecoms customer announced in November is progressing, and if possible, give an indication as to when they're expected to go live with the Cerillion solution?
Sure, absolutely. So that project is progressing very well, and work had actually started before we signed the contract. That should go live in terms of initial customers in November this year, with a gradual phase migration of the entire base over the next few months.
And the operating margins have increased from 11% in 2018 to 41%. Is the current level sustainable, and is it possible it might increase even further?
So I think, as I said, the margins that we reported in the first half of the year were buoyed to some extent by the high proportion of license revenue that we've recognised. I think, looking through to the second half of the year, we are expecting that to be slightly lower, and therefore we would expect the margin for the full year to be slightly lower as well. I think the reason why the margins increased so much over the past few years is because we have been winning larger contracts with larger customers. And what that has meant is that we have benefited from operating leverage as the incremental revenue from the larger contracts has dropped through to profit. On a sort of short to medium term basis, we are sort of guiding the market that our expectations would be for adjusted EBITDA to be in the region of 40 to 45%. But I think on a sort of medium to long term basis, as we hope to continue winning these larger contracts with larger customers, we would expect the margin to tick up further due to favourable operating leverage.
Do you think investors appreciate that your cash flow is always going to lag your profits by about 2 years, because you credit your profits up to 5 years before the cash is received?
Yeah, I mean, it's a good point. I mean, I think we've been clear. Our policy is to recognise, in line with IFRS 15, we do recognise the license revenue when it's available for use by customers. But a typical contract, which is 5 years long, we do have some contracts which are longer than 5 years, but a typical contract is 5 years long. Customers pay on an equal basis over 5 years, and therefore, there is typically a lag between recognising the profit and the cash coming through the door.
But I think it's also worth pointing out that that's only true for the term license element of the subscription fees customers pay. So on a typical new customer contract, that's about 25, 30%, maybe 35% of that order. The rest of the revenue, the services revenue to deliver the solution, is recognised on a project completion basis during the course of the the project. So that's generally in line with cash flow, and because the cash flow for that is based on milestone payments, project milestone payments. And the services wrapper within the subscription fees, the support and maintenance, managed services, hosting, that's all recognized on a straight line basis over the full course of the term. So I don't think we should kind of over-egg the point about the forward recognition of profit versus cash.
And how do you manage the workload when it comes to installing systems for new customers versus the sales that have been agreed? Is there a long lead time? And if so, how will you be reducing it?
Some customers want to get the solution implemented as fast as humanly possible. Others, more risk averse, want to take more time and do things more gradually. So there's a sort of a natural ability to control, manage our load within that. But also we have a lot of R&D going on most of the time, and we have the ability to switch staff from R&D into project work if in the short term if we need to, as a way to manage demand. There's also quite a large number of Cerillion alumni out there now, people who've worked for Cerillion over the years and might have moved on to go contracting or whatever, and so we have the ability to call back in some of those people. And we also have a number of different integrator partners who have worked around Cerillion projects now or been involved to some extent. I think as we work with more of these larger customers, we'll have more contact with those organizations. They'll be involved in more of our projects. We're passing on more skills. So the ability to find other people who can do work that we can't do all on our own is increasing. But generally speaking, we're set up to manage 4 or 5 large implementations at any one time, and typically as 1 or 2 things are coming to an end, something new starting up. So, for example, we just completed these 2 quite large projects in March and April that I was describing earlier on. That we have the newer ones that are taking over those resources. So there's a lot of levers we can use to deal with that. I won't say problem, opportunity.
And is there a geographic region where you're most optimistic about growth and capturing market share?
I think Europe is still by far the strongest telecoms market. There are just a lot more different types of telcos, more diversity, more opportunities to get into different areas. You've got power companies that are telcos, and a whole range of different business models operating in Europe that just create more businesses. I think it's hard to see Europe not remaining the strongest market, but I think there's a lot of space for us to expand in Asia and also in North America, where I think there's more opportunity than there has been for a long time. So yeah, strong in Europe, but room to do more in Asia and North America.
And total operating costs, including depreciation and amortization, in half 124 was flat versus half 123. I'm inferring from Singer's forecast that half 224 will grow by about 1.5 million. Have I misinterpreted Singer's forecast, or are you expecting extra cost in half 2?
I don't think we can comment specifically on Singer's forecast. And I think one thing we can say is that in the first half of 24 versus 23, we have benefited from the non-repeat of the £500,000 amortization impact. I think over time we are expecting operating expenses to continue to go up because we are growing. We're continually recruiting more heads in all of our offices, albeit we are recruiting proportionately more people in India and in Bulgaria. And of course, the average cost per head in those regions is lower, significantly lower than in the UK. So overall, that has been very helpful in terms of increasing our margins.
And do you have any concerns with regards to scaling up capacity to support new contracts or customers?
Not really. I think the reason for that is a couple of reasons why we're okay with that. One is that when we sign larger customers, although they're larger because they've got more end customers, so they've got more millions of mobile users or whatever, the services work involved in putting those solutions into service is not proportionately greater. So it's a bit harder to work with larger customers on larger contracts, but it's not a straight line in proportion increase. So as contracts get larger and customers get larger, we don't think we need massively larger teams. Bearing in mind that what we're implementing is the same product on each customer, for each customer. So it's not if we're having to customize software, write new software. We're generally just configuring. So that's gives us a much better starting point. And then the second thing is, as I said before, is we work with more partners. In time we expect partners to start delivering solutions on their own, under their own prime contracts. And obviously our longer term goal is to grow software as a more substantial part of the revenue mix. And to do that, we need to do less of the implementation work and more focus on providing the software and earning the software subscriptions. So that I think is a natural evolution that we will see as we go forward.
Can you explain your revenue recognition policy?
Sure. So there's really, when we sign a new contract, there's really three main components to it. So first of all, we've got the license element. Now, our accounting policy, in line with IFRS 15, is to recognise that up front when the software is available for use by the customer. Secondly, we've got the implementation revenue as part of the initial contract. Our policy on that is to recognise that on a percentage completion basis over the term of the implementation, which is typically over a period of sort of 12 to 18 months. And then the third point is everything else, so support and maintenance and managed service revenue. So this is recognised on a straight line basis over the term of the contract.
Can you explain the increase in long-term receivables, please?
Yeah, so this is mainly it's mainly driven by the increase in accrued income. So again, it comes back to the point on a higher proportion of license revenue being recognised. So our accounting policy, in line with IFRS 15, is to recognise the impact of license renewals when the contract renewal is signed. So we recognise that at the point that the renewal is signed, albeit in some cases it means that the cash will be received starting in future time periods. And I think this is what explains the increase in non-current receivables that you see in this instance.
Are there provisions for pricing reviews, inflationary or otherwise, on long-term SaaS revenue contracts during the period?
Yeah, most of our contracts include indexation clauses. So clearly that has been very beneficial in past years when inflation has been high. So typically we do pass on those indexation increases sort of each year during the life of the contract.
Great, thank you very much. And that's the end of questions. Louis, do you have any closing remarks?
Just to thank everyone for joining. Appreciate your time to listen to us. We're in a extremely strong market, a large market, where we have multiple entry points to find prospects and opportunities across this very diverse space within telco. And we have a unique proposition. We're offering the software as a service solution, single product for all customers, much shorter time to market, much lower total cost of ownership, much more flexible to use in it being a product solution, but also much more flexible to upgrade in that we can actually roll in seamless upgrades. Whereas in this industry, a lot of telcos are only able to upgrade every 4 or 5 years or so. So all in all, we think we're very well placed in this market, and there's a great future ahead.